Welcome to the strategy, double inside bars. As usual, we'll discuss what double inside bars are, when to use them, and how to use them. And we'll discuss also the timing, selection, and management behind the trade, and how we can essentially squeeze the most profit out of them. But just a quick recap, a double inside bar is exactly what it says on the tin, and I just want to show you what they both look like using OHLC bars and candlesticks. They're essentially where we get two consecutive days which are inside the range of each other. So we have what I call the mother bar, followed by an inside bar, which is inside the range of the previous bar, i.e. the mother bar, and on day 3 we have a third bar, the inside bar, which is inside the range of both bars. So it's essentially like a flag, if you like a Russian doll effect, whereby we have just 3 bars with bar 2 and bar 3 inside the previous bar's range. And this is how it looks like on candlesticks, exactly the same story there. And they're essentially inside bars which have failed to breach the high and low of the previous bar, and it reflects indecision, or where the market is hesitating prior to a reversal or a continuation. And funnily enough, we can actually trade double inside bars as both key reversals or continuations, depending on where they are in relation to key levels, as we'll discuss later. Again, just like with pin bar reversals, smash bars, and so forth, it really does not matter about the color of the OHLC bar or the candlestick, providing the profile of the bar is, or profile of the bars are essentially double inside bars. That is what matters. The color does not at all. And double inside bars are pretty rare, certainly compared to inside bars just on their own. That's why we pay more attention to them, for that very reason. They're rare, so if we do see them on a technical level, we've got quite a few reasons to be relatively enthusiastic about the potential outcome, providing we've got the reward to risk in our favor here. So like I just mentioned, double inside bars are rare, so rare in fact that it would be a shame to miss out on them. They really do reflect extreme indecision, and certainly if they're at a technical level, like a hard level of support or resistance, they essentially reflect a change in sentiment. So if we've got a double inside bar on the level of resistance, that shows to us that there is a transfer of power between the buyers, who are starting to diminish in power, and the sellers who are actually coming into the market to ricochet off that level of resistance where there's value for the buyers to sell. And what we want to do as traders is essentially trade the breakout of that and trade the bounce like we do at Lazy Trader. We're only interested in bounce trades, and double inside bar gives us a very good entry point or excuse to enter the trade, providing the technicals line up as well. If we do get a double inside bar, like we just mentioned, and there is no technical level in the way, i.e. no level of support or resistance, then that is a market breathing in before it breathes out again, so we can just trade it in the prevailing trend as a continuation. And if we do look at the hourly time frame or the smaller time frames, if we've identified a double inside bar on the daily time frame, they typically do correlate with a symmetrical triangle, which is a typical breakout pattern anyway. So just to recap, we can trade double inside bars as continuations or reversals. Reversals are more profitable. So this is what it looks like in context. This is Euro New Zealand here, and we had this opportunity as a reversal. You can see 2 inside bars here, like the Russian doll effect. Just wanted to trade the breakout of it, identifying this level of support as a reversal and this level of resistance as the next technical level where we can reasonably think about taking profit. And this is where we traded a double inside bar as a continuation. You can see we've got higher highs and higher lows here. This is Euro GBP, and it's an opportunity here, even though the reward to risk is dubious, it's an opportunity here to essentially buy the dip or the retracement. So we've got this bar inside the mother bar here, and the third bar here inside the range of both previous bars. So we could just trade the breakout of it in advance of a higher high, potentially up to here. So in a trending market, if there's no technical level in the way of our double inside bar, we only want to trade in the direction of the prevailing trend. That is where the probability is on our side here, rather than trying to beat the market or create waves in the market by going against the trend. Conversely, If we're looking at a range bound market, then we want to simply sell the top of the range or buy the bottom where there's sufficient supply and demand respectively. And this is where we can take advantage of key reversals in a range bound market, not in a trending market. And like with any lazy trader strategy, to qualify a key reversal or a trade continuation, we want to have as many ticks in the boxes as possible. So if our double inside bar correlates with obviously our level of support and resistance, and or trend lines, moving averages, Fibonacci levels, weekly or monthly pivots, and or big numbers, then we've got a higher probability outcome because there is more in favor of the trade. Okay, so in terms of actually placing our entry and stop loss for the double inside bars, we're looking to go long. We just simply, just like with any other lazy trader strategy, we want to look at the high of the second inside bar here and place our entry at the high plus the spread, whatever your broker is giving you, plus an additional pip. So your order long will be a little bit above the high of the bar, just so that it prevents you from being faked into the trade. And conversely, if you are looking to place your stop loss in, and we always urge you to use a protective stop loss just in case the trade doesn't go to plan, then look at the low of the bar here and place your order at the low minus spread minus an extra pip. And it's exactly the same way if we're going short. We just place our entry at the low of the bar here, minus spread minus a pip, with our stop loss above the high of the bar, plus spread, plus a pip. And of course, again, with any other lazy trader strategy, we place our orders for it at 10 p.m. GMT or very early the next morning GMT, providing the markets haven't had a chance to move overnight. So again, just like with any other lazy trader strategy, again, we manage it in exactly the same way. So if you know how to trail for the standard pin bar reversal strategy and the smash bar strategy, then you'll find this an absolute doddle. If we're looking to go long, all we want to do is trail for every second buyer bar until we're stopped out. We want to trail for every second buyer bar, because if we're doing it for every second buyer bar, then not only are we banking profit along the way, we're also giving our trade enough room to breathe or retrace prior to it potentially going in our direction again. And there's nothing worse than trying to micromanage a trade and ruthlessly manage it to the point where we're locking in profit aggressively, to the point where if it does go a tiny bit against us, that we're out of the trade before any more profit can potentially be taken advantage of. We don't want to do that. We just want to have a compromise and give our trade enough room to breathe and also lock in profit along the way. So same story really if we're looking to go short. See, we trade the break of the second inside bar with our entry at the low of the bar minus spread minus a pip, with our stop loss above the high plus spread plus a pip, and we trail for every second seller bar here, so that again we've locked in profit as well as given our trade enough room to breathe here. So again, it's a winning compromise, giving our trade enough room to breathe. So in terms of targeting, that really does depend on you. It depends what kind of person you are. If you'd rather have a high probability outcome, then select a smaller target, accepting lower reward. If you'd rather have a higher reward, then select a further target, but accept a lower probability. That's the trade-off in trading. And it really does depend on your personality, what kind of person you are. If you do decide to go for a high probability, low reward target, then you could typically expect to have a higher frequency of trades, although smaller wins, but you'll be most likely to have a higher frequency of winning trades to losing trades. However, if you do decide to go for the second option and accept a lower probability for higher reward, then you will accept to have a higher frequency of losing trades to winners, but if your winning trades will have a far higher percentage gain. But as with trade targeting, it is quite frequent for your trade, due to trade management, to be stopped out prior to your target being hit, because remember, we are trading our stop loss for every second buyer bar if we're long, or for every second seller bar if we're short. So quite frequently you'll be stopped out prior to your target, but it is always good to have a target set in mind, because that is your line in the sand. After you've placed your trade in the evening GMT, say 10 p.m. London time, simply walk away. If it's triggered within 24 hours, then great, you can manage it accordingly. If it's not triggered within 24 hours, then we simply delete our order, because that is a sign to us. If our trade's not been triggered, it's a sign that there is no momentum to the direction where we're looking for the trade to go. And if there's no momentum in the direction where we're looking for the trade to go, then there's actually little point in being in the trade, because as traders we just want to be proven right by the trade, by the market, and it obviously to go in our direction. But if it's not going in our direction, if it's just flatlining, then there's little point in being subjected to a laggard. So this is what happened to Euro New Zealand on the daily chart. We had our double inside bar here, we got triggered within 24 hours, and we had buy bar 1, and then we had the second buy bar, then we trailed it, our stop loss being moved to the low of the second buy bar, minus spread, minus a pip, and if we had 2 more buy bars we would trail our stop loss again. However, it hit our target prior to, so we obviously didn't trail it for a second time round, it just hit our target, so we're automatically exited out of the market by our broker. So in conclusion, double inside bars give us a legitimate reason to enter the market, providing they're at a technical level. If we're trading them as a key reversal or as a continuation, we want to trade them in the direction of the trend or the prevailing trend in order to have the highest probability outcome. They can be selected, timed and managed exactly the same way as other lazy trader strategies, i.e. trading for every second buy bar if we're long or for every second seller bar if we're short, and our targets are selected according to our reward appetite. Have a smaller target if you'd rather have a higher probability outcome but accept a lower reward, or indeed a higher or bigger target if you'd rather accept a lower probability but in exchange for that have a higher reward potential.